Good morning, everyone. I hope you're starting your day with a sense of curiosity and excitement, because today we're about to embark on a fascinating journey into the world of digital finance. Today, we're diving into the world of digital money, specifically Bitcoin. Whether you're a seasoned investor or just someone who's heard the buzz, Bitcoin has become a topic that's hard to ignore. Think of Bitcoin as digital cash that exists only on computers, secured by blockchain technology. It's a new kind of money that doesn't have a physical form, but is instead made up of code and cryptography. The blockchain acts like a public ledger, recording every transaction transparently and securely, so no single person or group can manipulate the system. Unlike traditional money, it's not controlled by any bank or government, making it appealing to many. This independence is one of the reasons why Bitcoin has captured the imagination of people all over the globe. People buy Bitcoin for different reasons. Some see it as a long-term investment, hoping its value will rise over time, while others use it as a hedge against inflation or economic instability. There are also those who trade Bitcoin for quick profits, taking advantage of its frequent price swings to try and make money in the short term. Its global nature allows for fast, borderless transactions without banks. You can send Bitcoin to someone on the other side of the world in minutes, with just a few clicks. This has opened up new possibilities for international business, remittances, and even charitable donations, all without the delays or fees of traditional banking. The underlying blockchain is also being explored in industries beyond finance. From supply chain management to digital identity, its potential is vast and still being discovered. Bitcoin has grown from a niche idea to a major financial asset, with its price movements making headlines worldwide. It's no longer just for tech enthusiasts. Now even large institutions and governments are paying attention. But with this growth comes risk. Bitcoin's price can swing wildly in a short time. One day it's soaring, the next it's plunging. And these dramatic shifts can catch even experienced investors off guard. This volatility can mean big gains, but also big losses. It's a double-edged sword that makes Bitcoin both exciting and nerve-wracking to follow. Understanding these risks is crucial. Before jumping in, it's important to educate yourself and never invest more than you can afford to lose. Yesterday's market action was a stark reminder of how unpredictable crypto can be. Even seasoned traders were surprised by the sudden swings. Let's break down what happened and why it matters, so you can better understand the forces shaping this new financial frontier. Stay tuned as we explore the story behind Bitcoin's latest roller coaster and what it could mean for the future of money. Let's dive into the dramatic events of Monday, September 22nd, a day that sent shockwaves through the entire crypto world and left investors reeling. What exactly happened, and why did it unfold so quickly? To understand, we need to look at the sequence of events that turned a seemingly ordinary day into one of the most memorable in recent crypto history. Early in the day, Bitcoin's price began to slip, and within hours, it plunged over 3%, briefly dropping below $112,000. This wasn't just a minor dip, it was a sharp, sudden fall that caught many off guard, especially those who had been watching the market's steady climb in the days before. The abrupt drop triggered immediate panic among investors and traders. Screens across the globe lit up with red numbers, and the mood shifted from optimism to anxiety in a matter of minutes. In total, about $1.5 billion was wiped out across the market in a single day. This staggering loss was felt not just by big institutions, but also by everyday traders who had put their faith and their money into the rising market. Much of these losses came from traders who had made risky bets, using leverage and margin, convinced that prices would keep rising. Many had borrowed money to amplify their gains, but when the market turned, those bets quickly became liabilities. As prices fell, exchanges automatically closed out these leveraged positions to prevent further losses, resulting in a wave of forced liquidations. For many, it meant watching their investments vanish in real time, with no way to stop the bleeding. The impact was global. Over 400,000 traders worldwide were affected, from seasoned professionals in major financial centers to newcomers trading from their phones at home. The sudden drop set off a chain reaction, a cascade of forced selling that pushed prices down even further. Each liquidation triggered more sell orders, creating a feedback loop that accelerated the crash. Just hours before, the market had been stable and optimistic. Many believed the rally would continue, but this sell-off shattered that calm, turning hope into fear almost instantly. It was the biggest one-day liquidation event in months, rivaling some of the most dramatic moments in crypto's volatile history. The scale of the losses stunned even experienced traders. Monday's event served as a stark reminder to everyone. The crypto market is unpredictable, and risk is always just around the corner. Even the most confident investors can be caught off guard. Prices can soar to incredible heights, but they can also crash, sometimes in the blink of an eye. The roller coaster nature of crypto is both its allure and its danger. For newcomers, it was a harsh and unforgettable lesson in market risk. For veterans, it was yet another test of nerves and strategy, a reminder to never get too comfortable. So what caused so many to lose so much so quickly? Let's break down the mechanics behind Monday's crash and see what lessons can be learned for the future. To understand Monday's massive losses, we first need to talk about two key concepts in trading: leverage and liquidation. Leverage is when traders borrow money to increase the size of their trades, hoping to amplify their potential profits. But this also means their potential losses are magnified. Imagine you have $1,000, but you use 10 times leverage. Now, you're controlling a position worth $10,000, far more than you actually own. This can be tempting, because if the price of Bitcoin rises just 10%, you don't just make a small gain, you actually double your money. That's the upside. But the downside is just as dramatic. If Bitcoin falls by 10% instead, you lose your entire investment. The risk is huge, and it happens fast. This is where liquidation comes into play. Liquidation is the process where the exchange steps in and automatically closes your position to prevent further losses, mainly to protect the money you borrowed. When your losses approach the amount you borrowed, the exchange doesn't wait for you to act. It sells your assets, often at a loss, to make sure you can't lose more than you put in. As a result, your initial investment is wiped out, and you're left with nothing in that position. On Monday, hundreds of thousands of traders who were using leverage found themselves caught off guard as the market turned against them. As prices dropped sharply, their positions were liquidated all at once, triggering a wave of forced selling across the market. This forced selling didn't just affect those traders, it accelerated the price drop for everyone, creating a snowball effect that made the crash even worse. The end result? A staggering $1.5 billion was lost in a single day, as liquidations swept through the crypto markets. Leverage can be a powerful tool to boost your profits, but it's a double-edged sword. It can just as quickly destroy your investment in a matter of moments if the market moves against you. Monday's crash was a dramatic, real-world example of just how risky leverage can be, especially in the fast-moving world of crypto. That's why understanding how leverage and liquidation work is absolutely essential if you want to survive and thrive during crypto's wild price swings. Next, let's take a closer look at how other coins fared during the chaos and what lessons we can learn from this turbulent day. Bitcoin wasn't alone in Monday's turmoil. The entire crypto market felt the impact. Ethereum, the second largest cryptocurrency, dropped as much as 9%, hitting a one-month low. XRP, Solana, Cardano, and Polygon all saw significant declines. Even meme tokens like Dogecoin took a hit. The sell-off was widespread, affecting both established coins and speculative tokens. When Bitcoin moves sharply, it drags the rest of the market with it. This interconnectedness means few coins are safe during a major downturn. Monday's sea of red showed just how quickly losses can spread. The ripple effect was undeniable. Let's explore what triggered this market-wide panic. So, what caused the sudden panic? First, too many traders were using leverage to bet on rising prices, making the market fragile. Thin liquidity meant there weren't enough buyers to absorb the flood of sell orders. As prices dipped, automatic liquidations triggered more selling, accelerating the fall. Activity in the options market added fuel, with some traders betting on big swings. The result? A cascade of forced selling that turned a small dip into a major crash. No single news event caused it, just a perfect storm of risky bets and market fragility. Now attention turns to what's next for the market. The next big event? This Friday's massive options expiry. Over $23 billion in Bitcoin and Ether options contracts are set to expire. Options let traders bet on future prices, and when so many expire at once, it can create huge market pressure. Large players may try to push prices toward levels that benefit their positions, a phenomenon called max pain. This can lead to unusual price swings and extra volatility. Some analysts think Monday's sell-off was traders positioning for this expiry. With so much money on the line, the market is on edge. The days leading up to Friday could be turbulent. All eyes are watching to see how this expiry will shape the next chapter. But that's not the only factor at play this week. Outside forces also shape crypto prices, especially the U.S. Federal Reserve. Last week, the Fed cut interest rates, making borrowing cheaper and riskier assets like Bitcoin more attractive. But uncertainty remains. Fed Chair Jerome Powell is set to speak, and investors are watching for clues about future rate moves. Another key event, Friday's release of the core PCE price index, the Fed's preferred inflation measure. If inflation cools, more rate cuts could follow, boosting markets. If not, markets could face more pressure. This mix of Fed policy and inflation data adds to the week's uncertainty. Crypto doesn't exist in a vacuum. Global economic trends matter. With so many moving parts, investors are bracing for more volatility, and there's more news from abroad adding to the tension. This week, news from China added another layer of caution. China's securities regulator reportedly told some firms to pause work on real-world asset tokenization in Hong Kong. The goal ensure these digital tokens are backed by legitimate businesses and risks are managed. While not a direct ban on crypto, it signals ongoing regulatory scrutiny. Such moves from major governments can unsettle markets and investors. Regulatory uncertainty is a constant risk in the digital asset world. Monday's sell-off wasn't caused by this alone, but it added to negative sentiment. Navigating crypto means watching global regulations closely. After a day like Monday, what should you take away? Crypto offers big rewards, but also big risks and sudden losses. Knowledge is your best defense. Understand what you're investing in and the dangers of leverage. Never invest more than you can afford to lose. Diversify your investments. Don't put all your eggs in one basket. Even within crypto, most coins move together during crashes. Avoid emotional decisions and chasing quick profits with high leverage. Focus on long-term goals and stay informed. Prioritize the safety of your money above all. That's the smartest way to navigate the exciting, unpredictable world of crypto.